How does the route that we've seen compare with some of the other periods of turbulence in emerging markets?
Well, this time around, we're getting some really alarming signals from some of the global assets that really make the weather for EM. If you look at oil, it's been falling, the dollar has been falling, U.S. Treasury yields have been falling, and the extent to which they're correlated is really quite unprecedented. In our first chart, you can see how Brent crude and the dollar have broken their negative correlation. Positive correlations are on the increase for oil and U.S. Treasury yields and the dollar and U.S. Treasury yields. And the fact that this is all happening simultaneously sends a very strong risk-off signal, and it points to the fact that investors might be pricing in or might be thinking about a recession, possibly in the U.S., a slowdown certainly in the U.S. And for emerging market investors, this is another slap in the face. You know, in 2018, the trade war ended the rally in EM assets. Investors had barely had time 2 years later to celebrate the signing of a phase one deal before the virus came along. And now as they're trying to price the virus into their models, you've got this oil price war between Russia and Saudi Arabia to complicate things.
Where is the risk showing up, Alex? Just give us a few specific metrics that you're looking at.
It's showing up all over the place, but if we look in the second chart today, we can see one area in particular. This shows us how spreads are blowing out between emerging market U.S. dollar debt and treasuries. They're up at the highest level since 2016 when we last had an oil price collapse. Now, if we want to take a slightly less negative approach to this, you could argue that when the sentiment does finally change and turn around, EM will be a massive magnet for investment. Of course, the question is, when on earth are we going to get to that point?
And Alex, you're in Russia, of course. It's at the center of the collapse in oil prices after pulling out of the production arrangement with OPEC, and it's taken one of the biggest hits from free fall in prices. How are policymakers going to react to this?
Well, let's pull up our final chart, and we can get a hint here from the derivatives markets how monetary policy might shape up in Russia in the coming months. Now, what we can see here is that forward rate agreements just a week ago were signaling rate cuts. Now they're showing as much as 80 basis points of increases over the coming 3 months. Now, as you know, Russia has been on an easing path. It's cut rates back-to-back 6 times in the past year. Growth is anemic. Inflation is near historic lows. So what's happening now in Russia is, with oil in the 30s and the ruble weakening to its lowest levels in 4 years, the central bank is going to be, unlike central banks in emerging markets, which are looking to cut rates or already have cut rates to spur growth, in Russia we're going to see the opposite, and the central bank is going to try and shore up the ruble with rate increases, potentially at least rates on pause at the next meeting, to avoid rattling financial stability.